Welcome back to another episode of Coffee and Coin. I got Whitby back on the pod. What up, Whit?
I think listeners think my real name is Whitby, just because you say that every time.
It is your real name.
Oh, okay.
And we have a very fun topic for you today. We were laughing right before we started recording because I said we have to make this content really fun. And Whitby, that's her given name at birth, was saying, but it's kind of a dry topic. And it is because we have a lot of tactical information to go over, but it's such an important topic. And the reason we wanted to talk about it is because so many women who come into the Wealth Circle have 401ks or will have 401ks or have passed floating at their former company 401ks. And they're kind of like, ooh, what should I be doing with it? So we wanted to break down all things 401k on the pod for you today. And that's what we're going to do. One quick announcement before we get started. The Wealth Circle is right around the corner. So that's right. If you are someone who has been listening for a while now and you are interested in taking it, the Fall Wealth Circle is going to be opening later this month in August, right after this episode airs. And we are going to be doing a Wealth Circle informational webinar on August 8th. So we'll link it in the show notes, but definitely grab a spot. If you've ever considered taking the Wealth Circle, you want to join this session because we're going to break down how it all works, what it's all about, what you'll learn, and you'll have the chance to ask our team questions live. So yeah, just wanted to give you that note before we jump into all things 401k.
Yeah.
You ready for this?
Ready.
So what the heck is a 401k?
Always a good place to start every podcast. Because some of our listeners may be very familiar, but others may not be. So, let's level set here. A 401k is an investment account that is offered to you through your employer for the purpose of funding your own retirement.
So even that, there's so many buzzwords just in that one statement, because I think sometimes people are like, well, an investment account, your own retirement. Here's the thing. 401k is a term that a lot of us hear out in the ether, but if you are someone that has access to it, and maybe let's just start there, Whitney, does everyone have access to a 401k?
So it's not a requirement for a company to offer a 401k plan. So while many companies do offer them, some don't. I think it's been estimated that about 56% of all companies in the US, like big and small, offer a 401k plan. A lot of corporations do, so it's going to depend on, the size of the company. So the answer is yes and no, right? Like a lot of times you will have access to one through your employer, sometimes you won't. If you work in the public sector, your retirement plan is going to have a different name, 403B, 457B, TSP. They're all essentially parallel to a 401k plan. But just note that if your company does not offer a 401k plan, there are still other investment accounts that you can open to save for your retirement. So don't be discouraged, but for the purposes of this episode, we're really going to focus solely on 401k plans.
Okay, got it. So not all employers offer them, but what makes it a 401k plan or the those other examples she mentioned in the public sector, is that it's being provided to you by an employer. Instead of you going out and getting your own individual retirement account, this is an offer from your employer. It's really a part of your benefits, right? That's why you just shared half of companies have them, because people want them. And so it's a way to attract good employees and keep them around if they have some sort of competitive matching program, which we'll get into later in the episode. So, okay, then what makes investing in a 401k so attractive, especially if we did just say there are other ways to invest for retirement?
Yeah. So, two main things make investing in a 401k attractive. One is that it's a tax advantaged account. And two is that, as you just mentioned, it usually potentially could come with a company match.
Yes. And the match is money that you don't want to leave on the table, which we're going to get into. But I thought it might be fun just to share a little background here that, and we talk about this in the Wealth Circle. We like to kind of give history on everything in the Wealth Circle because stories really help you cement your learnings. But, we talk about how the stock market got invented and what's happened over the years and first women in it and all that good stuff. But the background on 401k plans are that they were accidentally invented in 1978 by a guy named Ted Benna. He had devised a plan for a client who declined to use it in the fear that once the government realized the tax loss potential for them, that it would get repealed. So after this client rejected it, Ted Benna persuaded his own company to utilize it. And since then, it has been widely adopted, and the 401k has pretty much revolutionized the retirement planning approach. It's why it's become the gold standard that so many employers offer. Okay, so you mentioned 401ks are tax advantaged, but what the heck does tax advantage mean so that our listeners can understand why that's even important?
So when you invest in a tax advantage account, it means that you're going to get some sort of tax break, which is truly a big deal because taxes can often be our biggest life expense, and a lot of people don't realize that. So the most common type of 401k is what we refer to as a traditional 401k. And the way that tax advantage system works is that you do not pay taxes when you contribute money to your 401k in that year. You do not pay taxes when you trade in and out of funds that are in your 401k, but you will pay taxes when you withdraw the money. So decades down the line. So using that example, I would get, if I contributed to a traditional 401k this year, I would get that tax deduction of how much I contributed on my tax bill. Now, some companies will offer a Roth 401k in addition to a traditional 401k, and that tax advantage system works a little bit differently. With a Roth, it's basically kind of reversed. You do pay taxes on the money before you contribute it into your 401k, but the money is not taxed when you make trades in your account, and it is not taxed when you withdraw the money. So this effectively lets your money grow tax free because even the earnings that you withdraw on the back end are not even taxed. So you can either pay your taxes on the back end with a traditional 401k or on the front end with a Roth 401k.
Yes. And in both of those cases, they're still growing tax free while you're investing in them. So that's the awesome middle part. And then we're just talking about, are you getting taxed on the front end or on the back end? Because Uncle Sam is always going to get his. We talk about that a lot in the Wealth Circle, how taxes are basically a hidden wealth sucker that we don't really think about first because we know we have to pay them, but wealthy women do. They do start to think about this first because they can reduce that bill by being strategic with tax advantage accounts. And then I also just wanted to make a note here that if you have a 401k and you're listening and you're like, well, I don't know if mine's traditional or a Roth. Well, if it doesn't say Roth, then it is a traditional. That's kind of just become the nomenclature. You say 401k and you mean traditional, even though you're not saying the term traditional beforehand. Okay. So when would somebody want to choose traditional versus Roth 401k?
So both are beneficial because they're both tax advantage and they're both going to give you, a tax break in the long run. So the question really is it better to pay taxes now or is it better to pay taxes later? I mean, it's hard to say, right? Like, we cannot predict if taxes are going to be higher or lower in the future. We cannot predict what our overall financial situation is going to be now versus then. So, for me personally, I have decided to utilize both a Roth and a traditional account in my portfolio so that in years that my income has been higher and I'm looking for more tax deductions that year, I contribute to my traditional 401k because, again, I will not pay taxes on that money the year I contribute. And then in years my income has been lower, I've contributed to a Roth 401k because I just figured let's go ahead and pay the taxes now so that my money can grow tax-free and I won't have to pay taxes on the back end. So my recommendation really is to not worry about trying to predict the future and what the tax situation may be, but decide whether investing in a traditional or a Roth makes more sense for your tax situation like today in the year that you're contributing.
Yeah. And for listeners who are thinking, well, isn't there an income limit to contribute to a Roth? That is only for a Roth IRA. There is not that same income limit to contribute to a Roth 401k, but I have seen in this work, a lot less people have access to a Roth 401k. So typically you are utilizing that traditional 401k at work, and then people who want access to the Roth consideration, they're usually opening an IRA to do that. But again, only if they make below a certain income threshold.
Yeah.
So we're not getting into IRAs today.
We won't get into that because that is a bit confusing, but just know that you may have access to both a traditional 401k and a Roth 401k. And what we just went over is how you can figure out and decide which one would be right for you. If you only have one option for a 401k, easy. Like, that is answered for you.
Totally. Okay. So then how does someone go about opening their 401k? Let's say they do have an employer that offers one. You get hired. What are the next steps?
All right. So you start your new job and you're going to get all this HR paperwork, a beautiful benefits package. Don't toss that to the side. Look through it because that's where you're going to find information on your company's 401k plan. There will be, pretty clear instructions in there on how to enroll in your 401k. And when you enroll, that's essentially, it's going to open your investment account. But that's not where it ends. Like, you're not finished there. So make sure you continue.
But HR is finished there. Their job is to let you know about the account and give you that package and kind of help you to the portal and where you can open it. But this is where it gets really, really important to listen to Whitney because you're not done just by way of opening the account.
Yeah. No one's going to hold you accountable to making sure your 401k is truly set up and set up correctly. This is where you do need to do some self-educating. So open your account, but then make sure you proceed to the next step, which is figuring out, what you want your contribution percentage to be. Because if you don't set any contributions, that means you're not actually putting money into the account. So your balance will remain at zero. And that's not the point of a 401k. So your contribution percentage, that's going to be the amount that will come out of each paycheck and then get invested into your 401k. Now, I think this is the trickiest part because a lot of people say, well, what should my percentage be? Like, how much should I invest? My advice here is as much as you can because this only benefits future you. So, this percentage, keep in mind, it can be changed. It can be changed every pay period. Like, you're not locked in. So this is just a starting point. Okay, so let's say, example purposes, let's say you start with a 5% contribution. So that means if each one of your paychecks is $1,000 and you're contributing 5%, then $50 will go into your 401k each pay period. So set that. See how it feels for a couple of pay periods. If you're realizing you could really increase it, you could afford to put more in there, bump that up to 6%. Bump it up to 7, bump it up to 8. Keep going until you really hit your comfort limit, and then okay, 10% is my limit here. And if 5% feels too much, you can decrease it. You can go down until you find your comfort limit. So keep this process very fluid, because only you can answer the question, how much should you invest per pay period in your 401k? Because it's going to depend on your financial situation and what you're comfortable with. But experiment.
Yeah, I feel like this is also a really great benefit of the Wealth Circle, because one of the first things we do is a lifestyle analysis to see how much we spend in different parts of our life and if they are in line with our values, because the things you're spending on that aren't in line with your values and aren't going to give future you a return, you can get rid of those things and then you free up more money so that you can up the contribution amount in your 401ks. And we see women doing this all the time. They might just be contributing 2 or 3 or 4% or whatever their match is, and that's it. And when they realize, oh, I could really spend less over here and put away more over here, then they go and do it and they never feel bad about it. And there's this really cool law. It's called Parkinson's law. It's basically the idea, think of like a goldfish in a fishbowl. You're always going to shrink or expand to the size of your fishbowl. Like that's why goldfish stay small. It's the same thing with our accounts, right? So like if you are used to having a certain amount in your checking account, then you're going to shrink or expand that. But if you don't have it there, if you get it over into your investment account, so it has the opportunity to grow for future you instead of being spent on current you, you'll adjust to that as well. So I just always find that part of the Wealth Circle so exciting, because women are like, well, I'm only investing a little bit. And suddenly they ratchet it up and they've got like 20 grand in their 401k in 6 months. And they're like, wow, that wasn't as hard as I thought.
Yeah, so we want your expanding fishbowl to be your 401k and your investment accounts, not your checking accounts.
Correct.
Last step, though, in setting up your 401k is another huge one, because if you set your contributions but you never pick your investment funds, that means your money is sitting in a money market fund within your 401k, which actually makes it a glorified savings account, and you miss out on decades worth of investment growth. So this is another huge thing women discover in the Wealth Circle, that they set up their 401k, they set up their contributions, they never picked their investments. So that means their money was never invested in the stock market, and they were just holding cash.
And even worse, they thought they were, because they did all the right things about getting the account open, putting their contributions on, but if they didn't actually choose the underlying investment selections, then all that money is going into an account, which usually does sound like it's invested. Like it sounds fancy, right? But if it's not actually invested, then it doesn't have the opportunity to grow, because you want to invest in companies that are on the stock market, that are in these funds, so that those companies are out in the world selling products, making money, and giving you a return. But if you don't actually get the money invested into those companies by way of funds, then you just have your cash sitting there. And then you could have kept that in a savings account.
Right.
That you can actually access. You can't access this one.
So yes, please do not make this mistake. It is very common, but the more you're educated about investing and how to set up your accounts and how to get into, your investment funds, then the less likely you will fall victim to this. So real quick, just to recap, 3 steps to opening up your 401k is, you enroll through HR, it opens your account, you set your contribution percentage, make this a fun game with yourself. That I see that a lot in the Factory community too. It's like people are kind of it's a game. Like, how high can I get my contribution percentage? So push that to your limits. Truly, it's only going to benefit you. And then do not forget to select your investment funds. You want to be capturing that compounded market return year over year over year.
That's why we have these accounts, right? Like that is why your companies offer you investment accounts as part of their compensation package and a way to encourage you to stay with the company because they want you to focus on doing your job and they want to provide you with a place where you can invest for future you so that you feel good about, what's to come.
Mm-hmm.
So we did actually an entire episode on how to pick funds. So refer to episode 145 if you want to deep dive into that process. And, Whitney, you just said like, definitely don't make this mistake. But she's referencing at whatever new job you get because you listened to this before you got that job. If you've made this mistake, do not feel shame. Just go and look up your 401k after listening to this call and make sure it's not sitting in a money market or equivalent cash type account and get those investment selections made.
And correct it. If it is, you can easily correct it. Like go into your portal, say, okay, I actually want to move my money from a money market account to these funds. And, you fix the issue.
Totally. Okay, so we've kind of touched on the match, but let's talk about it because that can be a really big benefit of your 401k plan if your employer offers a match. So can you talk through how that works?
Yeah. So just like not every company has to offer a 401k plan, not every company that offers a 401k plan has to offer a match. So again, some do, some don't. I think it has been estimated that about, all the companies in the US, big and small, that offer 401ks, about half of them offer a match. So if your employer does offer a match, which you will also know from the paperwork you read through in your benefits package, just figure out exactly what that is and how you could take full advantage of it. So you'll want your minimum contribution percentage to be the maximum amount that your employer will match, at least the maximum amount. So just to reiterate Allegra's point, this is actually not free money. This is money promised to you as part of your job offer, as part of your benefits. So like if you're not taking advantage of it, it's on you. You are the one leaving these dollars on the table. So that's why we really encourage 401k investing, knowing what the match is and making sure you're contributing the minimum amount to get the full match.
Totally. So what would you say then is a standard or like typical match that companies offer?
Yeah, it is tough because there really isn't a standard. I have personally worked for, a startup company that offered 401k but offered zero match. And then I've worked for a Fortune 500 company that matched 75% up to the maximum contribution limit. So I've really been at places that offered the lowest match and one of the highest matches I've ever seen. But I do think what's more common is to see language that's similar to we'll match 100% of all your contributions each year up to a maximum of 4% of your annual income. So, using this as an example, if someone had a $100,000 salary, the company would match up to $4,000 per year. So that would be your minimum number to invest to capture the full match.
Got it. So then in that case, the employee is contributing 4K so that they can get their employer to match them that 4K.
Yeah, at least 4K, right? My encouragement to you is more.
No, we know that you want them to do the very most and to max it out, and so do I. But just in that example, if you wanted to get that 4% match from your company, you would be contributing the 4K of your 100K salary, and then they would double it, which is awesome. So at the end of the year, you'd have 8K. And so that's why you don't want to leave that money on the table. But if you don't contribute, or if you only contribute 2, they're only going to match 2. So you want to get that full match. And just as another example, Factora has a 401k. We do also contribute a 4% match, which is exciting because I've worked at a lot of startups and none of them had a 401k. So my last 401k was at the Estee Lauder companies. And if I remember correctly, I'm pretty sure it was a 3% match, but that was in 2010. So I can't be sure.
I think like 3 to 6% might be what a lot of people are seeing. But again, it's so all over the place that you really need to look through your benefits package that HR delivers you so you know what it is.
Okay. So when a company contributes to your 401k plan, is that money yours then to take whenever you leave the company?
Good question. Okay, so not necessarily, because your plan could have what's called a vesting schedule. So any money that you contribute, that like you put in on your end, that is yours to take whenever you decide to leave the company. But any money that your employer puts in as the match will be yours to take only when it is vested. So let me give an example of one of my old 401k plans. It was on a 4-year vesting schedule. So after 1 year, the money my employer put in was 25% vested. After 2 years, it was 50% vested. After 4 years, it was finally 100% vested. That means I was free and clear to take all the money that employer gave me in my 401k plan, and that is when I left the company for another job. I had been paying attention to the vesting schedule. I really wanted that full match because this was at the company that offered 75% matching. So it was a significant number. So I strategically made the decision to stay 4 years. But again, not all companies have a vesting schedule. Sometimes you're fully vested right away. Some companies might have a longer vesting schedule. This is another thing you do want to pay attention to in your 401k paperwork.
Yeah, this one's so interesting to me because it feels like they took the kind of, or maybe vice versa. Maybe corporates were doing these vesting schedules with 401ks, and then that's kind of how it transferred over to startups with equity, because it sounds a lot like that lingo, right? Like if you go to a startup and you get a certain amount of equity, it typically has a cliff, it vests on a schedule. 4 years is pretty standard. Interestingly, I have never worked for a company that's had a vesting schedule. You have been given that match in that year, yours to keep. And that's how Factora does it as well. So we're not going to claw back any money, to require you to stay a certain amount of time. But I see why companies do it, because it incentivizes you to not leave and for them to not have to give up extra money if you do leave early.
Yeah. And when you are interviewing for new jobs, because this is a benefit that like could potentially help you decide which job to take, these are actually all questions you can ask in the interview process. Do you offer 401k? What's the company match? What's your vesting schedule? And yeah, again, when you're educated about how it works and you're planning long term and you're trying to figure out, you have very comparable offers on the table, and like, how do you decide? This might be a deciding factor.
Absolutely. Also, just because I know a lot of women who listen to our podcast are in the startup world, and a lot of those early companies don't have 401ks, something else to ask is, what is the expectation of a 401k rollout? Like, get them to give you a year, a quarter, and stay on them, right? Because they aren't, and be noisy with your peers, because, if multiple people are pushing for it, they're going to do it. I had a company that I left before it happened, but I was like, hello, we've all been working here for a while. We've been asking for this for a while. It was a UK-based company, so they just didn't care about the American 401k. They were not in a hurry to figure it out. And it's costly for a company to set up, for sure, and maintain. There's administrative fees, etc. But anyways, we did push them to do it. I just didn't get to take advantage of it. But I'm glad that I helped leave that mark for people who did stay.
Yeah. I mean, companies know generally that 401ks are attractive for employees. It helps attract talent, it helps retain talent. So they know the benefits of offering a 401k, and if they're, a high growth startup, then it's likely that they're trying to get a 401k on their roadmap. I don't think you necessarily have to sell them too hard on the benefits, but yes, it does come down to logistics and cost in setting it up. So, stay connected with HR. Like, I'm sure they'll be pretty transparent in where they are in the process of trying to get a 401k implemented.
Okay, so now let's say you decide to leave a company where you were contributing to this 401k plan. What happens? What are your options?
Okay, so when you
and let's go ahead for this example. Let's pretend it's fully vested. So you're leaving and you have a 401k, and what's next?
All right, we're fully vested. We're leaving a company where we've been diligently contributing to a 401k. We took another job offer where we're going to start another 401k. So your options are, when you leave an employer, there are 3 options. Okay. 1, you can leave your money there. You can leave your money in that 401k, but you'll no longer be able to contribute to the 401k. Like, it kind of just becomes an investment account. It'll still grow. It's still invested in the market, but you can't contribute to it any longer. Second option is you can transfer that money from your former company's 401k to your new employer's 401k. You might want to do this because then it at least consolidates the number of 401k plans you have out there. Or the third option is that you can roll your 401k into an IRA. The benefit here is that you then have way more choices on which kinds of funds you want to invest in. Because remember, when you're part of a company's 401k plan, everything's going to be controlled by the plan administrator, like the match and what you can invest in. But as soon as you roll it to an IRA, that's an individual retirement account, you really have free reign on which funds you want to invest your money in.
Including where you roll it to. Like, you get to choose the financial institution. Whereas if you keep it at your old company, it's whatever they chose. And if you roll it into your new company, it's whatever institution they have set up. But if you pick to roll it into an IRA and you have other accounts at Vanguard or Fidelity or Schwab or wherever you might do your other investing, because every woman on this podcast also has taxable brokerage accounts and is investing plenty, then you can put it there for consolidation and more direct level control in that way.
Yeah, absolutely. And also, a lot of times 401k plans will actually charge a pretty hefty maintenance fee or administrative fee every year. Like, it's a common misconception that, like, oh, my employer offers this, it's free. No, they offer it, but you're still paying the maintenance fee. So really, another important thing to look into and know how much it's actually costing you to keep like a former 401k account open. And, like I said, a lot of times an IRA has lower administrative and maintenance fees. So you can definitely save there.
Well, and also these 401k fees, they're not that easy to find, but it is worth trying to figure them out. So, you can look for what are called participant fee disclosures, plan sponsor fee disclosures, or a form 5500. But yeah, I tried to do some searching on this. Tony Robbins talked about it a lot in his book, Unshakable, where a lot of times if people leave their 401ks at old companies where, again, you can't contribute to it, you've lost that opportunity when you've left the company. There is fees that could be like 1% to 2%, which is hefty over time. That's like almost paying a financial advisor to manage something, but there is no managing. Like it's just sitting there, hopefully growing, hopefully properly invested. But again, you can't contribute to it or do what you want with it until you get it out of that 401k into your own IRA where you have this direct level control. So I know for me, I'm a big fan of the rollover into an IRA. What about you?
Yeah. So, I mean, over the years, I've worked for many different employers. I've opened many different 401k plans, and then I have ended up rolling all of them over into an IRA. For me, I feel a greater sense of control with investment options, with knowing my account fees. And then ultimately, how confusing is it to have to track down however many 401ks that all these companies you worked out in the time of retirement? Like, you'll probably forget all the places you've worked. So for simplicity reasons, I like having all my money in one spot.
Totally. And I've also seen companies, they change providers and then people go to log in to where they thought they had their old 401k, but they no longer work with the company. So they didn't get the information. So they don't know it's actually been moved. And then it's a whole, just a heap of annoyingness to have to go back to your old HR and figure it out. So it is nice to keep track of this. Like, this is your money, you contributed, and you want to know where it's at. So if you are interested in learning more about how to roll over an old 401k into an IRA, we have an episode on that too. So check out episode 141. And if you're nosy and you want to know how much money is in Whitney's IRA, listen to our July roundup episode because she breaks down all the monies in all her retirement accounts. Okay, so I want to touch on 401k plan contribution and withdrawal restrictions so that listeners can be clear on those, because you get this plan, but you don't just get tax advantages for free. There's going to be some limitations. So how does that work?
Yeah. So, I mean, because the IRS is giving you a tax break, they're going to be putting some limits on how much money you can contribute in any given year, and then also they're going to, limit how much you can withdraw and when you can withdraw on the back end. So, for example, 2023, the maximum annual contribution limit is $22,500. That's the max you can possibly invest in your 401k this year. That is set by the IRS. For 2022, it was 20,500. So the limit typically increases a little bit each year. You can always do a simple Google search to understand what the current year's contribution limit is, and you can, if you want to max it out, you can back into your contribution percentage that way. So that's a real helpful way to set that. And then on the withdrawal side, because 401ks are for retirement, the earliest you can withdraw without penalty is age 59 and a half. If you withdraw before then, you could be subject to a 10% penalty in addition to paying ordinary income taxes on your withdrawals. So that's going to sting a bit. That's really going to eat into the amount of money you're able to access. But I do want to mention that there are some exceptions if your plan allows. Like, there's a loan option, there's a hardship withdrawal option. You could also look up these options, in your benefits package, but these should really, really be used as a last resort if you're truly in a pinch. Because again, this is money designated for retirement. So when you use it for something else, like, you're still going to be in the hole for saving for retirement. But essentially, yeah, with a loan, you borrow money from yourself in the short term and then you replace it through payments deducted from your paycheck. And then with a hardship withdrawal, you can take money without penalty as long as it's for a qualifying reason that your plan will list out. So it is options available to you. Only use it as a last resort and fully read through your plan paperwork so you understand how these options work and whether or not you truly qualify for them.
Yes, and I'll just share my story here that I've shared many times before. But I cashed out of my first 401k because I was starting a business after I left the Estee Lauder companies, and I didn't have capital for that business other than that 401k chunk. And I didn't understand that I was going to get hit with such a big tax penalty for removing that money and withdrawing it, from investments in this tax, like specialized tax account into just my bank account. So I only got like 40% of that money that I pulled out. And that was a big blow. Like I didn't even understand how that was all working. But, I was 25 and you live and you learn. And then you go and start a company teaching women about personal finance fundamentals and investment acumen.
But that's a really good example because I do think it's common because if you don't have the education around it to know how it works, you kind of think, oh, let me just take this money that's mine and put it somewhere else. But the reality is because you get hit with the taxes and the penalties, you're not actually getting that money, all that money you thought you were going to get. So be wise to how that works and your vesting schedule and all of it.
Totally. And I think, we just assume it's our money. It is our money. But remember, Uncle Sam said, well, it's your money and you get all the tax advantages if you follow my rules. You can't withdraw this until 59 and a half. So that is why I got such a hit. But the other component there is that this happens to people all the time. If they leave a job or if they have a certain life event and they're looking for a big pile of cash, they usually see their retirement account and are like, well, that's the biggest sum that I have. And sometimes they are forced to use it, which is why we spend so much time in the Wealth Circle going over all of what we're talking about on this episode, right? Like why the tax advantage retirement accounts are important, but why it's just as important to have taxable investment accounts that have no withdrawal restrictions, no contribution limits that you can access at any time for things you're going to need between now and retirement. Because something's going to come up. We just don't know what it is yet. And maybe you just want to buy a investment property in Hawaii. But okay, you're not going to be able to use your retirement funds to do that without taking a penalty, which is why you want to have other means available.
Yeah, and what Allegra is mentioning is called your account structure. So it's how your 401k works in conjunction with a taxable brokerage account, with an IRA, with maybe another investment account like an HSA. So it's how to strategically set up your portfolio with the right mix of taxable and tax advantage accounts and when to pull from these specific accounts, when it's appropriate, when it makes sense, and how to designate which what each account is for. And that's I think that's a huge takeaway for Wealth Circle participants.
Totally. And speaking of how to take money from these accounts, can you talk to us about how required minimum distributions or RMDs work?
Yeah. So, okay, on the flip side of things, when you invest in a 401k or a tax advantage account and you just don't need the money, like, hey, go you. You don't need to withdraw from those accounts even during retirement. Well, you can't hide from paying for those taxes forever. The IRS is going to want their share. So even if you don't need the money, the IRS requires you to start withdrawing from your retirement plans at age 73. And this is what is known as the required minimum distribution. So this age has actually changed over the years and it'll likely be different by the time you retire. So it's another thing you could Google to simply find out what the RMD age is. And then the age requirement and the withdrawal percentage, it's dynamic. So the older you get, the lower your RMD percentage gets, and that's because your life expectancy is decreasing. So there's like fun RMD calculators you can play with online if you're interested in seeing how that works. I think I will have no problem starting my withdrawals at 59 and a half. So if you're a special person who just wants to stock this money away for even longer, just be aware that RMDs will come and they will find you eventually.
Yeah, it's funny because, that is a big amount of time. Like you can start withdrawing at 59 and a half, but you don't have to withdraw until age 73. That's like another almost 15 years. You can get maybe 2 doubling periods out of that, which is another investment term we teach in the Wealth Circle. We can't get into today, but so many people love the idea of getting their money to double, right? And so if you have more time to compound and you don't need the money, that is an opportunity. Okay, I feel like we did a great job of covering what the heck a 401k is, why to use it, how to use it, matches, contributions, withdrawal, RMDs, all this goodness. So I hope this episode was really helpful. Final reminder, just if you want to learn more about the Wealth Circle, what we teach, how it works, who all joins it, definitely check out our Wealth Circle informational webinar on August 8th. You can sign up from the show notes. But Whitney, thank you so much for giving us all the deets.
Yeah, thank you for having me again. And listeners, if you have any follow-up 401k questions, any questions about the Wealth Circle, email us at info@factorialwealth.com and we will happily get those answered for you.
Awesome. Thank you.
Thank you.
If you enjoyed this episode, come join us in a Wealth Circle. It's our live, online, 12-week course and community where we teach you how to create a personalized financial plan alongside hundreds of other women building wealth. It will change your life and your money for good. You can apply at factorialwealth.com/wealth circle. That's factorialwealth.com/wealth circle. See you in the next episode.